GPT-5 is out, and it was about the most disappointing AI release that I have seen in years. I think we are clearly reaching a point with artificial intelligence that improvements are not advancing very quickly. And there's going to be a lot of companies that are going to be very disappointing over the next few years. The AI bubble is likely going to burst. And that means that the companies that don't have a sustainable business model are going to collapse in value. I'm going to give you 10 stocks that I would stay away from right now because their artificial intelligence story is not going to be a great reality in the future. My name is Travis Hoium. Thanks for watching Asymmetric Investing. If you want more from me, check out Asymmetric Investing, my newsletter. There's a link on the screen and a link in the show notes. That's where you're going to get more research from me and also all the stocks I buy every single month. Started that portfolio from zero, has absolutely crushed the market. So check that out if you want to follow my market beating portfolio. I also want to thank this video sponsor, Fiscal.ai. I'm going to use Fiscal AI throughout this video, so you're going to see exactly what I'm talking about, but this is the best research tool that's out there today for fundamental investors. If you want information about valuations, margins, you want transcripts, SEC filings, investor presentation, all of it in one place with 20 years of data on their enterprise solution. If you go to fiscal.ai/ASYM, they'll give you a 15% off. You can try it out for 2 weeks for free just to make sure you like the product. This is a product I pay for, so putting my money where my mouth is. But let's move to Fiscal AI and start with the first stock that I think is going to have a very disappointing future. That is SoundHound. SoundHound has a $5.5 billion market cap today. Enterprise value to sales multiple is over 40. And guess what? They're not profitable. But the stock continues to be really highly valued because this is one of the growth stories in artificial intelligence. So where does that fall apart? Let's look at a couple of things here. The first is this orange line is their gross profit margin. So this is how much money are they making on each dollar in revenue that they're generating. So it doesn't include sales costs or general and administrative costs or even R&D costs. This is just what is the gross profit for the business. And you can see this gross profit level has been dropping like a rock, now down to about 41%, and that's over the past 12 months. If we go to their quarterly numbers, you can see that their most recent quarter, their gross margin, just 36%. So the margins are not good and they're getting worse. This is for a software company that should have really, really high margins. The other thing is their operating losses are getting bigger as the company grows. So their operating expenses, just keep this in mind, $131 million in revenue over the past 12 months. Operating loss, $241 million. And if we go down here, you can see that they are spending nearly as much in SG&A expenses, $116 million, as they are generating in revenue. R&D also over $90 million. That's shockingly close to what they're generating in revenue as well. So we're not seeing operating leverage in the business. They've had to make acquisitions to goose their growth. I think this is going to be one of these companies that's going to be very disappointing for investors in the future. Definitely not worth the $5.5 billion that is currently trading for. Stock number 2 is C3AI. Great ticker for the artificial intelligence wave AI. And I think that's actually something that has really helped the stock over the last few years. But the company's operations just don't back up this being a $3 billion company. So just look at some of the metrics behind it. Like I said, $3 billion market cap, enterprise value to sales is about 6. So not all that expensive if you're a high growth and profitable company, but not a profitable company. 3-year revenue growth rate, 15.5%. That's okay. But in artificial intelligence, even something like Alphabet's cloud is growing at double that rate right now. But let's look at some of the financials. And this is their revenue in kind of this charcoal color. Operating profit is in orange, and then revenue growth is in blue. And I'll change this here to the trailing 12-month numbers because this gives a little bit better picture. You see that growth has actually picked up. So 25% growth over the past year. They just reported earnings this morning as I'm recording. That's why the stock, as you can see at the top here, is down about 23%. So those most recent numbers are not in this chart, but you can see that the biggest problem is they're losing almost as much from operations as they're generating in revenue. That is an unsustainable trend. Something, again, we saw with SoundHound, unsustainable for C3AI to be able to be burning this much cash, losing this much money. And you have to ask yourself, how is a company like that going to get out of this hole? You need to see improvement in margins. You need to see operating leverage. With operating leverage, you say, okay, if I'm going to grow revenue 20%, my operating income is going to improve 40%. That's not at all what we're seeing. In fact, these operating losses are getting worse as the company grows. So just not a very good trend for C3AI. Absolutely one that I would stay away from right now. Number 3 is one that I've talked about a fair amount here on this channel. and in my rating on asymmetric investing, and that's Palantir. Now, Palantir is in a different story. Palantir is a very good company, actually has some of those operating features that you would like to see from some of these other companies. So just look at the metrics here, $440 billion market valuation, but the enterprise value to sales, 127 right now. Price to earnings ratio over 600. Even on a forward basis, you're still at a 250 price to earnings multiple. And this is for a company that has pretty mature operations. You can see here, you are seeing that operating leverage in the business. Compound annual growth rate, about 31%, solid growth rate. The growth has actually improved in the past few quarters. But again, this is a company trading for 127 times sales. If artificial intelligence is indeed in bubble territory, and I think that's what we're seeing with some of the lack of improvements over the past few months and the past few quarters from a lot of these companies. AI tools just are not getting better at the rate that they were in 2023. And so if companies are not profitable with the tools that are now not getting better, I just don't see how you're going to have exponential growth over the next few years. Palantir indeed may be the operating system for governments and for corporations in the future with artificial intelligence. But unless that addressable market is growing exponentially, the company is just not going to live up to that massive, massive valuation. This is not necessarily a call that Palantir's business is going to be in trouble over the next few years, but it is to say that the price for the stock has a ton of optimism built in. And if that optimism does not play out as investors expect, it wouldn't be surprising to see the valuation come down. And that could mean stock could fall 80, 90% just from multiple compression. So something to keep in mind for investors. One that may surprise you on this list is Oracle. Oracle is one of the companies partnering with OpenAI to build out these huge new data centers. They're spending billions and billions of dollars and expanding their AI exposure, seeing a ton of growth from that. But here's the problem. Market cap currently $702 billion. And you see that this enterprise is about $100 billion higher than the current market cap. So what exactly is going on there? Let's go into the financials. Here is Oracle's revenue in red, net income in blue, and free cash flow in orange over the past 20 years. And you can see that for most of the past decade plus, this has not really been a growth company. So what's happening over the past few years? Well, they've had a ton of growth in artificial intelligence and basically becoming more of a data center or cloud company. But in this period of time, between 2011 and 2022, 2023, the company was pretty stagnant. So what were they doing with their cash? Because you can see in this orange segment, they did have solid cash flow. Now that cash flow has not grown significantly really since 2011. 2011, $10.8 billion worth of free cash flow. You can go to 2021 up to $13.8 billion. Not a huge increase in free cash flow. But here's what they were doing with their cash. They were buying back stock at a really rapid rate. That's what's in red right now. You can see that 2019 bought back $36.6 billion worth of stock. You may notice that the red segment, especially from 2013 to 2023, is more than the free cash flow that was generated. You can't just create cash to buy back stock out of thin air. So Oracle started taking on debt. And you can see that really starting in 2014, 2015, the company took on significant debt to buy back stock. Now I'll take away these first two segments, and you can see that right now, debt load is about $93 billion. $93 billion of debt, generating about $20.8 billion worth of operating cash flow. That's what's now in red. And spending all of that and then some on capital expenditures. So Oracle is going to be one of the most leveraged AI companies today because of that debt load, because they don't have a huge cash generating business the way that Microsoft and Alphabet and even Meta do. They can just use their operating cash flow to build more data centers, to buy chips. Everything that they need to do for artificial intelligence can come from the cash flow that they're generated from their business. Oracle can't do that because they don't have that much cash flow. So they're taking on debt. So this is now a very highly leveraged company in, at best, the 4th or 5th place in artificial intelligence clouds. I think Oracle is going to be one of the companies that we're going to look back on making very poor decisions today because of this leverage. Stock number 5 that I would stay away from is CoreWeave. CoreWeave's $62 billion market cap today. Enterprise value, I'll get to the debt for them in just a minute. But the real reason the CoreWeave exists, the real reason that they've gotten as much cash and as many chips as they have is because NVIDIA doesn't want to be reliant on the big hyperscalers. So they want to sell chips to independent companies. That is what CoreWeave does. Basically just a company that buys GPUs and then rents them out. So here's a couple of things to look at for CoreWeave and the reason that this is going to be such a risky company. You can see solid revenue growth. They are making positive operating income, not making positive net income, which you can see here. But here's the challenge. That operating number includes depreciation on the data centers and the chips that they have. They are depreciating those chips on a 6-year straight line schedule. That is running under the assumption that especially those NVIDIA chips, which by the way, they're updating that chip year after year after year, that they're going to be generating revenue for 6 years. That is not likely the case. Those NVIDIA chips are going to burn out, some of them, but more likely than not, they're going to be obsolete. They're going to be obsolete 3 years from now, 4 years from now, 5 years from now. That means that eventually CoreWeave is going to have to write off a lot of these chips. I think that's going to result in ultimately losses. So we don't have a lot of operating metrics to show that this is going to be a profitable company long-term. This is also another company like Oracle that's not going to be able to fund its operations with the current business. So cash from operations is in green here. You can see not a lot of cash coming in from operations. Capital expenditures exceeds that by more than 10x right now. That makes sense because they're building out their infrastructure, their neo cloud. But how are they doing that? They're doing that with debt. So they're taking on debt to build out assets that are not currently showing that they have a solid return on investment. And you have the huge risk that if these assets, particularly those chips that they're buying, don't have the kind of payoff years from now that management currently thinks that they do, that is ultimately going to be borne by shareholders. And that debt is going to be leverage for investors. So that's why I think this is one of those companies just too risky to buy right now. There are better ways to buy hyperscalers. All of the big hyperscalers are going to be generating their own cash flow. They can fund their operations from the cash that they're generating from their core business. You don't have to worry about these massive risks from debt or getting the depreciation schedule wrong. Number 6 is a company that a lot of people think is going to be a huge beneficiary from artificial intelligence. I just don't buy it. That is Salesforce, $230 billion market cap as I'm recording today, trading for a pretty good premium to the market. 6 enterprise value to sales multiple and price earnings multiple of nearly 40. Look, AI tools and agents are supposed to be a growth driver for the company, but let's make this chart a little bit easier to read. Let's go back to 2018. You can see that their growth rate is now down into the single digits. Yes, they're becoming a little bit more profitable. That's good news. But this should be a growth company. This should be a company that's able to stave off disruption and actually put itself in a really good position as more AI agents are available. That also means they should have less headcount, which isn't really the case for Salesforce today. I don't think the efficiency promises that we've seen from a lot of these artificial intelligence companies, including Salesforce itself, is actually showing in the numbers. And at the end of the day, a lot of the things that Salesforce does could be done by other artificial intelligence tools. So that will continue to be a challenge for the company. This is one of those businesses that sells to a lot of very large companies. They have a very expensive subscription service. That doesn't really translate well to smaller businesses. And if AI is successful, as a lot of people think it is, it's going to mean more small businesses, more nimble businesses that don't need the massive infrastructure behind Salesforce. I think that puts the company in a really tough position. I'm not going to dig too much into this one, but Apple is another one I think is very, very poorly positioned for artificial intelligence. This should be a company that is leader in AI. You can move all the inference for a lot of different calls on device. Apple should be able to do that, but they can't get out of their own way. They are focusing on absolutely the wrong things. Siri is an absolute mess. Their partnerships are a mess. The only thing that they can do is just sell more devices, but it looks like they are going to miss out on this artificial intelligence wave, whatever that means for hardware and software companies. But this is the problem with massive incumbent companies. It is very, very hard to change directions of your business when you're the leader in the market. Apple doesn't want to sell fewer devices. He wants to increase services revenue. How are you going to do that with artificial intelligence today? Well, you may need to cut off your Google search deal. You may need to acquire a company for maybe tens of billions of dollars. You may need to change your user experience. Apple is not the company that's going to be able to do that. This happens over and over again. The companies that win in the PC don't win in mobile. The companies that win in mainframes didn't win in PCs. Apple is going to run into the same thing. They won in mobile. They're going to continue to be a dominant company there. But right now, the stock is trading for 35 times earnings. And this is a non-growth company. 3-year compound annual growth rate, 1.8%. And here's the thing that may surprise you. Their hardware sales peaked in September 2022. They have been in decline ever since then. Yes, some of these sales are starting to pick up a little bit. Had a good quarter for the iPhone in the most recent quarter. But a good quarter does not mean 15, 20% growth. It means that it's growing a little bit. That's a problem for Apple because that means that new devices are being made by other companies. The more compelling platforms are going to be things like Android and the Android wearables and Meta's devices they're coming out with. That's where the innovation is happening today. It's not at Apple, and I think that puts the company in a really tough position, trading for a very, very high multiple. It has deserved that over the past decade, but I don't think it deserves it over the next decade. Company number 8 is Tesla. Tesla has been an AI story for years, but the reality for Tesla is that AI is not driving the business. This is since the middle of 2022. So basically since the ChatGPT moment. Remember, we had Dojo back then. That was supposed to be their AI super chip, whatever that was. They actually fired that entire team last week, just disbanded that entire team. So that's not going to be a product for Tesla. They're moving into inference on device with their own chips. That makes sense for the FSD operations, but you got to get FSD to full autonomy, which they still have not done, even in Austin. There's a safety driver sitting in the right-hand seat. They're not in front of the steering wheel, but is a person that can stop the car if there's an issue, just like a safety driver would. And the business is deteriorating before our eyes. You can see that revenue is now in decline. $97 billion in revenue was the peak. That was in September 2024 quarter. 2025 has been absolutely terrible. If we just look at the quarterly numbers, here's where you can see the huge decline in revenue first and second quarter, and things are going to get worse as 2025 goes on because the regulatory credits they've been a huge beneficiary of, those are going to go away, at least in the US. Rivian already told us that. Tesla did not mention that on their conference call, but that's going to be a headwind. The $7,500 tax credit is going away in the fourth quarter of this year. Artificial intelligence is a story at Tesla, but the reality is this is an automaker. It always has been, and it will be for the foreseeable future. Until we get some sort of robot actually out in the world, I'm skeptical that that is going to happen anytime soon, or that's going to be the kind of product that's going to sell in any sort of scale. So Tesla has a $1.06 trillion valuation, a price to earnings multiple at nearly 200. And I think that those earnings are going to continue going down in the future. This is a stock that I would absolutely stay away from, as is Supermicro Computer. This was, again, one of the hot stocks when AI kind of took off. Now has a $26 billion market cap, but I don't know that there is a big competitive advantage for them versus any of the other companies in their space. They have a really impressive growth rate, 62% compound annual growth rate over the past 3 years. Price to earnings multiple, 26.6, but they did have accounting issues. That's what caused the stock to absolutely crash last year. They have recovered from that. But I think this is one of those spaces that's going to get more and more competitive as more companies come into the market and NVIDIA takes over more of some of the things that Supermicro Computer was doing in the past. So could this continue to be a growth company? Sure, it could. But we have seen over the past few years that there's enough questions about Supermicro Computer to just put this one in my too hard pile as an investor. The final one for today is Resolve AI. It's a company that's working with retailers, brands, and manufacturers. A lot of the things that they're doing on their platform are essentially wrappers around chat, like ChatGPT. I don't see any huge competitive advantage for a company like this in the market. And if you look at the financials, they really back that up. On a forward basis, enterprise value to sales is over 23, still not profitable, negative 15 price to earnings multiple. Here's their most recent filing, $188,000 worth of revenue, $138 million worth of losses. Yes, I said those numbers correctly. This is a company that's almost worth $1 billion. And I just don't see where there's a competitive advantage or signs that they're going to be able to turn this into a profitable business anytime in the future. This is absolutely a stay away for me as an investor. So the 10 stocks that I went over today: SoundHound, C3 AI, Palantir, Oracle, CoreWeave, Salesforce, Apple, Tesla, Supermicro Computer, and Resolve AI. Let me know what you think about those 10 stocks. Look, if this is an artificial intelligence bubble, there's going to be a lot of companies that suffer, and the companies that aren't making money or are carrying a bunch of debt in their businesses are going to be the ones that are going to do the worst. I think these 10 stocks really exemplify that. So let me know what you think in the comments section below. Don't forget to subscribe to Asymmetric Investing here on YouTube, and also check out my newsletter. Like I said, link in the screen and a link in the show notes. And if you like what you see on the platform, fiscal.ai, go to fiscal.ai/ASYM. Thanks for watching, everybody. See you here next time.